The purpose of today's session is to look at the summer 2014 question 1. So again, this would have been the compulsory question, the case study that you would have seen if you were sitting last year's summer paper. So one of the first things I want to point out is the information that was provided by the examiner report from the summer 2014 paper. So if you look at the examiner report, June 2014, one of the key points that was made was candidates who approached the case study logically and prepared workings for each adjustment and within prepared statements tended to score well. So the whole idea here is it's important to have some approach or structure. The question can be long. So if you look at here, the question for 2014 was 1, 2, 3 full pages of information and then a page of requirements. So what you need is to have a fully clear step approach and have a practiced under time pressure before you go into the examination. So one thing that I always give to students is I take a 3-step approach. Again, it's important, it's only suggested, but to the extent students get an idea of what kind of approach you should take in the exam, you can then tweak it to how you approach the exam yourself and practice it over studying. So the first one here is to assimilate what you've given. So understand what is given and also what the requirements are. I always tell students look at the requirements first, because then you understand what to look for and what to expect when you're reading the question. Similarly, then you analyse your workings. So all of the workings should be done in the appendix. So no workings in the middle of it. So leave a number of pages, which I'll show you in the sample question that we'll do, and then go into your workings. And important, have them neat and also have them well labelled so you can cross-reference to your financial statements. Finally, then once all the work is done, you then just populate your financial statements at the very end. Okay? So if we go back and we look at the question, summer 14, again go to the requirements first. So for 40 marks, or 40% of your paper, you're asked for a profit and loss and comprehensive income and a statement of financial position. So straight away, even without reading the question, we know we don't have to worry about a cash flow statement. We don't have to worry about a statement of changes in equity. We're only focused on the 2 primary ones. Part B, draft an appropriate accounting policy. So in that regard, and disclosure note for note 1. We know straight away we need an accounting policy and we're going to pay particular attention to note 1. And then directors believe that there's no accounting adjustments as a result of note 7. So again, we're going to particular attention to note 7, comment, and also if required draft an accounting disclosure note. While I won't pay too much attention to these today, it's important to note that that is still 10% of your paper. And one of the points was, if you go back to the examiner report, question B, which was the disclosure note, was very poorly answered. Candidates expect to be able to draft disclosure notes. So again, one of the reasons the examiners put up reports is to give guidance to future students and where they felt students fell down on. So that was one of the main parts. So for this, I would advise students, 1, obviously understand what the standard disclosures in each of these standards are, but also have some template set of financial statements in there. So for example, Deloitte do them, I'm sure the other big 4 do them as well. But if you jump to say page, they give standard financial disclosures, standard notes and disclosure notes across each of the standards. So it's a very comprehensive sample set of financial statements that you will be able to use as a template, particularly when you're unsure how should I structure this with regard to disclosure note for a certain standard. So by very much get a template, print them out, have them tabbed, and bring them into your day of the exam. So going back then, we've now understood what the requirements are. 40 marks, I think it's about 80 minutes, 85 minutes. So again, watch your time. So we go back to the question. We're told first part is assimilate, so we know what we're asked for, what are we given. So here we're told whole rate is sale of hardware products, wholesale and retailer. It's 14th of May, so again always watch for dates when you're doing this first run through. Understand what the dates are. And draft trial balance, so it's a trial balance for this year. And request you review both in documents, so the trial balance and outstanding items. And finalise the profit and loss and other comprehensive income, so your SOCI and your SOFP. And he wants you to include all your workings and explanations. That's fairly okay. So that's essentially what we've done for step 1. We understand what's required of us, a SOCI, statement of financial position, and then we also have 2 small disclosure notes as well. Next one is analyse the workings. I'm always a big fan of read down a high level through each of the workings and make some points as you go down along. Particularly if students are going to use their 20 minutes at the start, you won't be able to write on the exam or on your exam script. So it's useful to get into the habit of writing, this is relevant standard here, this is IAS 16, or linking notes of information or linking notes to numbers in trial balance. So my approach is always go down through each of them. What are you given here? So trial balance, nothing seems out of the ordinary there. We have a revaluation surplus. If I see that, I'll always flag it. There may be an issue. Dividend paid. We know that doesn't go into our P&L, so I'll make a note there to myself. And also watch for this here. This has been a popular format for the examiner in recent years, is to put closing inventory in your trial balance. Typically, students will see that the closing inventory is given as a note, and you're told you put it then in the statement of financial position and the SOCI. An alternative way of presenting it is you put the closing inventory in here, and you actually just show cost of sales. So before you would have only seen opening stock and purchases, but now cost of sales. So closing inventory is already incorporated here, and it's already embodied in cost of sales as well. It's the exact same way of doing it, it's just a different presentation. So make sure you're comfortable, as the examiner has taken that presentation route in prior years. So briefly walking down through each of the requirements. First thing, working one, intangible asset, 170. So I like to tie that back. Does that rec? It does, 170. So you can link that, put note 1 there so you don't forget it. Related costs. So 15% expenditure on surveys. So straight away, even before reading a lot of it, we're look, that's IAS 38, intangible assets. So you'll be picking up marks and you'll be settling yourself as you go down along. So just a very much high level read. So expenditure, research, we know there's an issue there. 40% expenditure on customer listings, useful life of 2 years, so we know there's an issue there. And also expenditure, purchasing rights to sell a product G, so that's alright, and we're given some cash flows. So straight away you're thinking, why am I giving cash flows? Well, there may be something to do with value and use or an impairment issue. So that's IAS 38, briefly. Come to the attention directors of another company has obtained the rights to sell product G. So Whole has been provided assurances from the other producers that would have sole rights, but it turns out they don't have sole rights anymore, and they've revised their cash flow projections. So the problem is here now, and this is why it's good to read them, is that if you didn't read and you jump straight into a calculation here, this actually links. So I would put a highlight here, link 0.2 to 1C, and we'll come back to that again. But again, relevant to IAS 38. So during the year, Whole began selling product H. In addition, Whole is providing a maintenance service of product H also for a 3-year period. So it can be sold together for £6,000, alternatively it can be sold separately. So once you practice your standards, you'll know straight away this is revenue recognition and IAS 18, the bundling of products. So nothing more going down the line. Retirement benefit obligation, we know straight away that's an IAS 19, so with your pensions, defined benefit, and you're kind of prepped that you know IAS 19 is coming up. Here you have property, plant and equipment, so again straight away I'll be looking at IAS 16. Alright. Whole uses cost model for its buildings and equipment and revaluation model for its land. Again, always ask yourself, why am I told that? Well, if we know the revaluation model is for its land, we're already flagged up here, page 4, there's a revaluation surplus, so we know that is now for land. So you can always try and tie your information in your first 20 minutes in your run through. Gives you a good overall understanding of the question. And then we're told about depreciation. We're told about certain additions during the year, what they're made up of. So we know some may be not appropriate and have to be expensed. And then we're also told professional valuation of land for 3.1 million at the end of the year. So we'll have to link that back to our knowledge of the revaluation reserve, and it's carried out a revaluation model. Alright, so that's IAS 16. So current tax charge, so straight away we know there's a tax issue. Some students may read it in depth. I'll be able to find, look, that's IAS 12. I'm going to move on and deal with it when I actually start doing my calculations. Note 7, which we know from reading we have an issue. So we have to think about disclosure notes here, whether it's relevant or not. So during the year 31st December, Whole sold 280 grand and 160 grand worth of goods to Doris and Boris Limited. Doris is owned and controlled by one of the directors, who is deemed to have control of Whole. Boris is owned and controlled by a son-in-law of one of the directors. So the clear issue here is it's a classic related parties transaction, IAS 24. So I suggest you go back, cover your IAS 24, and then test yourself, is there any disclosures required, and if they are, what format should they be in. So that's an IAS 24. And finally, whole rate weighted average cost of capital as in 10%. I mean, you always have to ask yourself here, well, why is it told it's 10%? And that should be linking back here when I'm given my cash flows up here, about what the potential cash flows for the product is. That may link into calculating a value in use, i.e. what's the future cash flows discounted at an appropriate rate to determine if there's an impairment on my intangible asset. So linking point 8 to point 2. Okay? And the final one we're also asked is, well, is there an appropriate disclosure note for note 1? So we know note 1 was to do with intangible assets. So I straight away, even my 20 minutes when I can't write anything, I'll be getting up my template set of accounts and I'll be looking for, well, where is intangible assets? What are the standard disclosures there? So I know what to expect. Okay? So that might have taken 4 or 5 minutes, but from that perspective, you are now primed that you understand what's required and what are the main standards being examined, and in particular linkages between them. So I think what I'm going to suggest now is we move on and we work through each of the workings in the appendix. So I've just done an Excel, but when you're doing an exam script, I typically leave 1 page at the start for my SOCI. Now, one point to note is I took it very much shorthand, so SOFP, I've used abbreviations. One point that the examiner has made is a number of errors are noted in the presentation of statement of financial position and profit and loss. And it's also come down here that there's an author talking about very sloppy presentation likely to lose marks. The fact that you have a template set of financial statements in there, the fact that it's open book, there should be no excuse not to have the appropriate full title here. Statement of comprehensive income for the year ended, for statement of financial position as at, and the full title. Some students like to do the format out straight away and just leave some gaps. Other people like to leave it at the very end and just leave pages as they go. The point being, always leave a page for the SOCI, leave a page, 2 pages for the SOFP, is typically longer. And because you know what requirements are up here, you'll know that, well, actually, I don't need to leave a page for my statement of changes equity or cash flow because I'm not asked for it. So we'll jump straight to the workings, and we'll deal with working 1 first, to do with intangible assets. So we know our intangible assets is 170 grand, and the first one is 15% expenditure incurred during the year carrying out the surveys and market research. So you know straight away anything to do with research is not allowed. Therefore, it shouldn't have been capitalized, it should be expensed to, and more than likely, distribution costs. So you'll debit distribution costs. You'll debit that 15,000, and you'll also credit intangible asset because it's no longer appropriate to have it in, and that will be another 15,000. Alright? And I'll always put a note here, DC. So I know when I'm coming back again. Now, some people do it in red, some people will do it in circular, and I've shown in the prior workshops, just to keep a note what you have to, where that has to go into when you're accumulating up all the information. So again, gradually working down through the workings and you're building up marks. The next one then looks at part B, 40,000 expenditure incurred on purchasing a customer listing. But we know that's external, it's not internally generated intangible asset, therefore it's allowed because it's a purchase. However, the directors of Holdrate expect to be able to use this list to obtain new customers for 2 years, for this year and next year. Therefore, it should be amortized over its useful life, which is 2 years. So we'll debit distribution costs, and we'll credit intangible asset. So we're going to debit distribution costs of 40,000 over 2 because it's 2 years, and likewise we're going to credit intangible assets. So again, I'll be taking my distribution cost label and bringing it here so I won't forget when I come down along again. Okay, so that's the second part, and I might put a little note here. Again, it's important to explain, if you even do the calculation wrong, explain your basis. Amortize intangible asset over useful life. Just to explain what you're doing. Because some of them may be straightforward, but if you do make a mistake, at least you're giving the examiner an idea of what you're doing it for. Okay? third part of this working then focuses on 1C, the 115,000 expenditure was incurred on the first of the year, so 1st January 2013, purchasing rights to sell certain product over the next 5 years. So again, external, these are allowed under IAS 38. And one thing that I did oversight at the first is I would put in IAS 38 as the relevant standard, just so you know to the examiner. So again, you might put in here amortize intangible asset over useful life as per IAS 38 or as per IAS 38. What the examiner does not want to see is regurgitation of a paragraph of the standard. They just want you to know that this is the relevant standard and you know how to apply it. So you spend 115 grand for over the next for an asset that's worth something over the next 5 years, so the rights to sell a product. Upon purchasing these rights, whole rate agreed not to sell the rights to a third party. And the net cash flows earned 85 grand in year 1 and 70 grand year after. But the benefit of us having read all the requirements first is that we know point 2 is also relevant. So we would have linked and we'd have drawn that diagram or drawn that arrow to link both of these. Because it came to the attention afterwards that while you thought you had exclusivity on the rights to sell G, someone else also had the rights. And because of that then, the cash flows are now projected to be, instead of 70 grand a year, only 35. And whole rate are also looking for damages of 150 grand, and the solicitors feel that there's a 75% chance that they're going to get those claims upheld. So the first thing is, well, what about our intangible asset? You know its carrying value, so its carrying value today is 150 grand. Or we want to know, is it impaired under IAS 36? So we're not given anything about its fair value, but we will be able to calculate its value in use. And that's why you should have, from your readings, you would have linked point 2, point 1C down to here, the weighted average cost of capital. Because you know your value in use is the discounted value of your future cash flows. So the cash flows are 85,000 for year 1, so up here. And instead of taking the 70, if you hadn't realised point 2, you would have taken the 70, but it's also actually 35. 35 for year 2, year 3, year 4, and year 5. So total cash flows are 225,000. Now that is not what to use for the value in use. You want to get the value in use using the time value of money. So you get a discount factor. So you can either use your tables if you have them, or know the formula is 1 over 1 plus R, which in this instance we look back is 10%. So 1 over 1 plus 0.1, power of, and we put the years here. And down now for 4 years, 5 years. So we'll just put that to decimals, and we have our discount factors for each of the years. So now you're going to discount the future cash flows for each of the years by each, so multiply that by that, and you get your value in present value terms. And now again, granted I'm doing this a bit quicker, but you can stop the video at any time to figure out what the value is. And that essentially, that 178,100 is your value in use. And you know then you have to figure out, well, if my value in use, is it bigger or smaller than my carrying value? So carrying value is 150, value in use is 178, therefore no impairment under IAS 36. Okay, so that's all you need to do. You need to firstly understand and link point 1C to 2, and also you need to understand what they use for the weighted average cost of capital as well. Second thing a lot of students forgot was, it's only for 5 years, therefore as with the second one you must amortize over the useful life. So it's the same, I'm only going to copy it down, but you'll have to write out the separate things. We're going to amortize the 150,000, that's its carrying value, over 5 years. Okay? Sorry, it's 115,000. Apologies. So 115, it doesn't change because carrying value is still, value in use is still bigger than carrying value, and it's now going to be 23,000 over its useful life. So what is useful to do before you move on to the next working is summarize. So your intangible asset, what is your tangible asset going to be? Well, opening value was 115, so it's plus 115, minus your expensed off 15,000, minus your expensed off, or you amortized here 20,000, and you amortized here 23,000. So your intangible asset at the end should be 57,000, whereas the opening value is actually 170,000. So if you look from the question, it's 170. One of them was made up of 115. So you take that and you actually intangible asset then, and I'll put here of SOFP, non-current asset. Alright, and that's the way I put that. And if you want to summarize distribution costs, you can summarize them to be plus this distribution costs for your write-off, this for your amortization, and this for distribution costs. And you can summarize them then into one page, so you know when you're coming back to fill it out, that's all done. Okay, so that's your working one. Working two then, we're going to look at, we've already dealt with part of this, we've dealt with 150 grand. The other thing is here, Colruyt are now seeking damages of 150 grand because they thought they had the exclusivity, but they don't. And they think there's a 75% probability. This is what's known as a contingent asset. IAS 38. It needs to be virtually certain before included. Because it's not virtually certain, it shouldn't be included. Now you may have a note, but it's not relevant for this perspective. What it's looking for is IAS 38. Student recognises it's contingent asset and recognises it shouldn't be included because it's not virtually certain. Typically virtually certain, as a rule of thumb, is about 90%. So working three then, we know this is IAS 18, revenue recognition, because we've already read down through it. So during the year, Colruyt began selling product H. In addition to Colruyt providing a service, so there's a product plus the service element. Alright? So there's two different things here, and this is what's called bundling under IAS 18. So sold together, they cost 6,000. Product separately costs 5,500, and the maintenance costs 1,500 a year, right? So it's important to understand that. So the maintenance costs 1,500. So the total of them separate actually costs 7,000. And what you have done is they've sold 80 products during the year. So total revenue they've said was 80,000, 480,000, which is essentially 80 times 6,000. And you have to figure out, you used to realise then, well actually there's two separate things here. You sold the product, which you can be recognised revenue straight away because it's a singular transaction. Whereas the maintenance contract, which is actually over a 3-year period, so that's important. So you can only recognise that revenue over 3 years, and the products were sold evenly throughout the year. So the first is, well, how do we get the split? Well, how you get the split is you say the product was 55, so the product price of the thing will be 79%, whereas the maintenance is made up of 21%. So that's how you get that split. Okay? So then, because you sold them all together at 6,000, you say the revenue. So for the product or for the service. So of the 6,000, so 6,000 times 79% means 47 is attributable to the product, plus 6,000 times 21%, 1286 is attributable to the service. And based on that knowledge, you know what can be recognised and what can't. So we know we've sold a product, we've sold 80 products times 47. So that's okay. We can recognise fully that 377,000 straight away because we sold the product and the risks and rewards of ownership have been transferred. However, for the service, we can only recognise 80 units times 0.5, and we do 0.5 because they were sold for 2013. They were sold evenly during the year, That means at any one time you would assume half a year's of service have been worked times 1286, because that is the total value of the service over 3 years, divided by 3, because it's a 3-year service. So actually, for 2013, you can only recognize revenue of 394,000. You've actually recognized revenue of 480. So 480 minus 394 means there's going to be deferred revenue of 85,714. And one thing what you need to do then is you need to split that into, well, what revenue, deferred revenue, is related to the next 12 months. So current liability and non-current liability. So for the next 12 months, you're going to have 1286 times 80. Okay? So it's 1286 times 80 over 3. So it's 34,000 for the next year, and then the remaining then must be for the following 2 years and a half. 85 minus 34, so 51. So that's important from that perspective. Is it's a bundle of a product. You sell the product straight away, you can recognize the revenue straight away. However, for the service element, it's over 3 years, therefore you must allocate that revenue over 3 years. So the double entry is debit revenue of 85,417, and you credit deferred income, current liability, and non-current liability. So current is 34 for the next year, and non-current is the residual. Okay, and that's under IAS 18. A fairly typical adjustment under that. So I would put there SOCI, and I would put there SOFP, CL, SOFP, NCL. I put them in red so you know you should make an adjustment. So the next step then is to do with your IAS 19. We've already talked about before. We've looked at it. IAS 19 to do with your pensions. It's always useful in this regard to, I think it's to split it into 3 or 4 columns. So you have your asset column, you have your liability column, and then you have your SOCI, and then you have your SOFP. Okay, so it's important to be aware of that, and maybe some people actually might like to put in an OCI column here as well for the remeasurement. So that just makes it fairly straightforward once you're moving down the line. So the information you're given is, you're told the retirement defined benefit obligation in the draft trial balance actually represents the closing scheme for 2012. So you're saying 95 and 210. So if you go back up here, we'll show the retirement of 115. That's actually the opening balance, not the closing balance. So what's your dates? 2012. So opening balance on the asset account is 95,000. On the liability account is 210. So then we would have known the opening balance on the SOFP would have been the 115, which links to the trial balance. Now we want to figure out, actually we have to make adjustments to account for this during the year. The first thing we're told is about service costs. And the double entry here is, well, service costs we're told, payroll costs for the pension go to the cost of sales. So service costs, they increase your liability, and they're written off to the statement of comprehensive income, 28,000. And note that is to your cost of sales. So it's useful to go through like that you're capturing what has to be expensed off in every line item. So that's your first, service costs. You debit P&L, cost of sales, and you credit your liability. Benefits paid. So we have another one, benefits paid, and this essentially is you reduce your assets 20,000 and you reduce your liability. So it's credit assets 20,000, credit liability 20,000. No impact here, right? Because it's a netted off. Next one is your total contributions paid by whole REIT during the year are, so contributions paid is 22. So that will increase your asset for the year. Okay. So the double entry here is typically the double entry for contributions paid is you debit your pension asset as so, and you credit your bank with the contributions paid. Now the suggested solution is credited this off against cost of sales, and to be consistent I would do it this way, but in particular in Connolly's book, Kieran Connolly's International Financial Accounting book, you will see that it's typically credited off against the bank instead, but just to be consistent in case to confuse students. The final one then is your interest expense. So you're told each year you're assuming that you use a standard yield of corporate bonds of 6% to assume we assume the interest will be earned on our assets 6% and will be incurred on our liabilities, all based on the opening balance. So based on them and adding them up, you get what you think the balance should be at the year end. Right? So this is what you think the balance should be. So 230, 600 and 102, 700. So again, the suggested solution just rounds up to 103 and 231. We're just being a bit more specific because we're in Excel. However, we actually know that the closing balances, we're told in the question, the closing balance in the assets is 105. And we're told the closing balance of liability is 250. That means we know where it's going to be in the balance sheet so we know straight away that's the SOFP. So we don't have to do any more work. We know where the SOFP is. That's 145. What we do need to know now is the remeasurement gain or loss. So remeasurement. So that means we have a remeasurement gain here of 23, but we have a remeasurement loss here of 19.4. So actually for the OCI it's minus 19.4 plus 2.3. So that is OCI, because remember any remeasurement gains, this is what we thought they'd be, this is what they're actually according to the actuaries. Therefore 17.100 actually goes to your OCI. So based on that then we can do our summary position of pension obligation, which is 145, and that goes to SOFP. Then we have cost of sales, where we know our cost of sales, we are saying it should be 28, and this is also included in for the consistency with the examiner. And the solution, we have a cost of sales, it's going to be 6,000. So it's increasing your 28 with minus 22. So that's 6,000 to your SOCI, cost of sales. And then finally you also have your finance costs. Your finance cost, which is the difference between your interest expense netting off your interest gain, which is about 6,900 or 7,000, SOCI, finance costs. So a neat summary there, and the final one then is remeasurement, which is 17.100, and that goes to your OCI. So we have a nice neat summary then to put in straight away when you're finished. So the next one then is working 5. So we go down along, and we're dealing now with the property, plant and equipment. So I would put straight away IAS 16 as the relevant standard. So if we look at working 5, we're told cost model for its buildings and equipment and revaluation model for land. One thing to note here is depreciation has already been charged for the year. So that 14,350, if I try and rec that number back, you go up here. 14,350 is already here, which includes depreciation for the year. Typically in many questions depreciation won't be charged, but it has been charged already this year, so watch for that. So during 13, the company carried out extensive renovations of 80 grand, so link the 80 grand to here. And it includes 50 grand of materials, so we know that's okay. 15 of labour, 5 grand of its own wages, we know that's alright as long as it's directly involved in the renovation work. Repainting costs we know are not allowed under IAS 16, nor advertising costs, nor food and drink. So a total of 8 plus 5 plus 2 are not allowed. So we would credit PPE of 15 grand, and we will debit, or we call it cost of sales, just to be consistent with the solution. But you could also, well, all depreciation is covered in cost of sales, but you could also say that because it's to do with relevant cost, you can put it in admin if you want, but we'll put it in cost of sales. And then you'll say we could put inappropriate capitalization of expenses as per IAS 16, just to be consistent. And I will put here, just to copy down, cost of sales, just to be don't forget. So next one then is, don't forget, because you've already charged depreciation, some of the 15,000 that you've charged as depreciation, well actually, it shouldn't have been depreciated, it should have been fully written off. So you now have to make good that depreciation. So you know in cost of sales, some of the depreciation is already done, and it's 10% for equipment. Therefore, for depreciation, the cost of sales, you'll have to add it back, which is 15,000 times 0.1. So that depreciation is no longer relevant, and then you will debit to increase your property, plant and equipment. For depreciation is no longer relevant, 1.5. So adjustment for incorrect depreciation of expenses, because we've already expensed them up here. So again, another adjustment to your cost of sales. Okay. The final part in that question then is, you're told you don't have to worry about the rest of the depreciation because it's already been charged. And that was important for students to pick up, that it was charged for the year already. So professional valuation of 3.1 for land was obtained in the end of the year. So land carrying value is 3,600 not. So 3,600,000. Its fair value is 3,100 not. Therefore, there's a loss, revaluation loss of 500,000. And it's important to understand when you're dealing with IAS 16 and revaluation losses, you first write off any revaluation reserve. And we know that the revaluation model was done before, and that's why it's important from our first pass of looking down through it. We had an asterisk here that we're actually revaluation surplus. We'll knock off our reval reserve of 400, and then we'll write off to cost of sales, or again you can put it in distribution cost if you want, or main, of the residual, which is 100. So it's important that students do not forget that firstly you don't write off the whole 500, some of it goes to your evaluation reserve. So debit reval reserve of 400, debit cost of sales 100, and then you credit land, or in this case probably plant and equipment, of 500. And that's your adjustment done. Now don't forget that here, this is an OCI item, it should be put in. This is a cost of sales item, so you'll just know when you're working down lines that you won't miss them. So I think it's useful at the very end to always put a summary. But what's our property, plant and equipment going to be now? Well, it started off at 14,350 from here. You took off 15,000. Took off 15,000 for inappropriate capitalization expenses. Add back 1,500 for the depreciation effect of that, and take off 500,000 for the revaluation of assets. Gets you to 13,837,000. So that's just in thousands. So that's a summary that will go into the balance sheet. So you can put SOFP here of non-current assets. Okay, just put it in red. So you can put the summaries for the cost of sales you want, but I think we'll move on to finish off the rest of the workings. So the next working then is to do a working 6. You're told current tax charge for the year ended was 185,000. On a review of the tax return for 2012, it was noted that the tax charge had been overstated with 20 grand and was refunded during 2013. This payment has been accounted for by debiting bank, which is correct, and crediting other income in the draft trial balance. So I reference students here to workshop 2, where we covered off some of this before. This is workshop 2 or workshop 3, where we looked at Chauver's limited to question 1, similar enough prospect. So we know if we go up to the balance, trial balance, in other income, there should be a line here, other income, finance cost and other income of 20, we know that relates to a tax refund, but actually shouldn't be other income. It, as per IAS 12, which is rather than standard, it should be netted off against the current tax for the year. So the tax charge for the year is debit tax of 185,000, and you will credit tax in the balance sheet of 185,123. So that is SOCI, that is SOFP, current liability. As well as that, you'll also have to debit other income, so shouldn't have the 20,000 there. You actually just use that 20,000 to write off the tax. So credit tax in your P or SOCI of 20,000 as well. So the point being, it shouldn't be shown in other income, it should be just netted off of your other tax liability. Therefore, tax in the SOCI is going to be plus 185 minus 20, and that would be for your SOCI element. And then, so you can actually delete this one up here and just leave it as a, here's your SOCI element for tax, and then we know your SOFP element is 185,000. Alright, so that just gives you a summary. When you're going back to look, you have them captured. Finally, then note 7 is actually, that's to do with your related party transaction. There's no adjustment to be made there because you're not doing group accounts. You're actually, it's more a disclosure note, which I'll leave to you to look at your IAS 24 and be able to draft the appropriate disclosure note, perhaps by looking at your sample IFRS. So the final step I always tell students to do is then to aggregate some of the main items that you can just pull in there when you're populating the financial statements. The first one is your cost of sales. So if I look at the trial balance, the first one is 13,450, and I'll say that taking that from trial balance. So just you show the examiner where the figures are coming from. And I remember from all my labeling, and that's why it's useful to label then. First one is section 4. I have cost of sales. All these are summarized down here. So all I'm taking in is plus 6. So I'm just going to summarize them in thousands, be consistent with the examiner solution. So plus 6, working 4. I also know working 5 to do with the property, plant and equipment. I have 15,000 increased cost of sales. Cost of sales is actually reduced by 2 because of the depreciation adjustment, and it's increased by 100 because of the write-off of land. So it's plus 100 for the land, plus 15 for the riding expenses, minus 2, which is just rounding of the 1,500 for these purposes. And I've referenced working 5. So just add them together, 13,550 plus 6 minus 2 plus 1,5 gets you to 13,569. And that's the figure that will be taken in or to my statement of comprehensive income. Same working for distribution costs. So just really summarizes where's the trial balance. Let me just bring this down to reference. So distribution cost, the trial balance is 2,450, and again I'll be consistent, do TB. So again, you may want to do a columnar as opposed to in rows. Either or is acceptable. So I go up then, where's my distribution costs? We're working 1. I know I have 15,000 plus the 20,000 for distribution costs. So here, 15, 20 plus the 23. So 1 for write-off and 2 for amortization. Do I have any other distribution costs? So it's 58 in total. I've just summarized. I look down along then to see do I have any other distribution costs, and I don't. So that's why it's very useful. It's very quick then. Working 1 plus 15 plus 20 plus 23, and then I can get a summary of 2,450 plus 15 plus 20 plus 23, and that is the figure 2,508 that will be brought into my statement of comprehensive income. Exact same approach for admin expenses. We're told here 1,560 from the trial balance. I'll do a quick look up along. Even I don't remember myself from going through any of the workings. Do I have any admin expenses? I don't. So therefore, I just say there's no other workings, and I'll just take the 1,560 is 1,560 and put it bolded. So now I have 3 of the main working items. Then instead of doing workings in the face of financial statements, I will just reference working 7 in my SOCI when I do it. So the final step you now take is to go back up, because you'll either have some students may like to populate them beforehand and have all the relevant line items, obviously leaving some gaps, or other students might like to put in the figure or the line items as they go along. So now you're trying to populate the financial statements. which is the final step here on the suggested approach. Finally then, we're going to populate the financial statements. So it may be the case that you put, I typically leave a column on the left hand side of the numbers for a note to either reference a working, or sometimes you may not think it'd be useful to just have an extra working and working 7 to accumulate up. You might just put it on the face of it. So for example, revenue, we know if we look at the trial balance, that revenue was 19,890, right? But if we look down through the workings, we know we did deferred revenue of 86, so we round up, so a SOCI of 86. So we go back up then, and you can either put it here as a note of 19,890 minus 86, alternatively, and you could reference there whichever working it is, working 3. Alternatively, you didn't like the look of that. That's why I say a lot of times people can put extra ones in working 7 and just cross-reference working 7. So either or would be acceptable, but at the extent of a lot of workings like this in the face of it, it wouldn't look as neat. So this would be plus 19,890 minus 86. So 19,804. Cost of sales, we already have from down here, working 7. It is 13,359. So just add them up. Now your cross-reference working 7 there. Likewise, working 7 for distribution costs and admin expenses. So I would say distribution costs we know from working 7 are 2,508. Admin expenses we know from working 7 are 1,560. So again, that's the beauty of this 3-step approach, is that once you come to this final step, a lot of it is just transcription. You have a lot of the workings marks got already, and this is just finishing them off. So we know from our balance sheet the other income, well, there's none left because we wiped that out, so that is nil. Finance costs, again another working here. We know it's 530 in the trial balance, but if you remember correctly from before, we would have made a small adjustment to finance costs in our working 4 of 7,000, or 7,000, which is just 7 in this case. So again, it's useful to sense check down to make sure you haven't forgotten anything. So you could do this in working 7, or I'll just do it on the face of it, is 530 plus 7 from working 4. Okay, and that gives you to 537 minus 537. So adding them up all the way down should get you to a profit before tax of 1630. Income tax for the year, well, I remember working down here from before. Working tax, so it's always good to try and keep an idea of what the workings you did. The working tax, and that's why it's good to check first our SOCI, working 6, 165. So you have SOCI working 6 minus 165. And that gets you profit after tax of 1465. But don't forget, you also have OCI items, which is the remeasurement of pension, and you also have land valuation. So the remeasurement of the pension, you can put a note here if you want. You know that's going to be working 6 or working 4. The remeasurement of the pension, if you look down along for any OCI items, there's an OCI item in working 4 of 17. So minus 17, so it's a loss, minus 17. And you also have the land revaluation. We know from working 6, I think it is, working 5 is OCI 400. So that's a minus 400 OCI, minus 400. And that is working 6. So you can see working 5. So it's very neat and very quick once you get to that stage. That gets you to 1048 is the total comprehensive income for the year. Let's keep that the same format. Keep that on page. So 1048 is total comprehensive income for you. Total comp income for the year. And that's your statement of financial, or statement of comprehensive income done. Great. Now granted, I've gone shorthand, but you should go longer hand, and you should actually use each of the definitions of, or the labelling for each of the line items and the line item on top. The next one then is to look at your SOFP. So property, plant and equipment we would have done already from working 5 I think it is. Working 5 we already figured out property, plant and equipment in CAS, what's useful to label, of 13,837. So I'm just going to round. So working 5, 13,837. Our intangible asset, where we know that it was working 1, we scroll down to working 1, our intangible asset. That's why it's useful, as well as having here, is to summarize at the end, so you just know you can pull straight in 112. And as well as being useful for you, it's also useful for the examiner, that they'll be able to follow your logic. Of 112. So we'll add them together, and that gets you to 13,949. So just put a table there. So inventory, we didn't do any adjustment to inventory, so we looked to our tangible, our trial balance. Do we have any inventory? Inventory should be here, of 450 closing inventory, right? And I just referenced there TV. Same with trade receivables. Trade receivables here of 325. And cash, so look down bank and cash. Watch this for students. A lot of students may have put this in current assets. It's on the credit side, therefore it's a current liability. So examiner is trying to catch out students that are not paying attention. So while we have it here, we'll put it in. So we can put in here overdraft current liabilities from the TV. Should be here. And that is 135. So just do it as you figured it out. So that means the current assets, this is 775. So total assets will be 775 plus 13,949. So 14,7 is that element done. Ordinary share capital, we didn't do any adjustments. You should remember from a lot of that. And this will come with practice. We look down for ordinary shares is 150. Share premium, we don't have any share premium. That's in from another one. So we have retained earnings, or evaluation reserve is number 1. Well, actually, we know from evaluation reserve it was 400 opening balance minus 400 from working 5. And we know that because we wiped out all our under evaluation. So that OCI item comes in here, and that means it's now nil. So it's important to get practice with that, but you remember the OCI item comes in here. And that's your TV. And the final one then is retained earnings. So students have an option whether they want to do the return earnings balance here. Because it's a bit involved, I will reference working 7. So we go down to working 7, just to be neat. We go retained earnings. First you'll take your trial balance as normal, 4750. We'll take profit for the year. Now remember, you only take the profit before other comprehensive income. So that is 1465. These are dealt with separately. 1465. And you reference there the SOCI. Don't forget, any dividends also impact on it. So dividends you're told are 110. So that is minus 110. And I'd say TB dividends. And also, to be consistent with the solution, I'm also going to put in here the pension obligation of 17. That alternatively typically is shown separately as a separate line item in the OCI, in the other other equity components. Apologies, but in this instance, just to be consistent with the solution, they've incorporated into here. Okay, so the final one is your pension is minus 17. So if you add them up, plus 4750 plus 1465 minus 110 minus 17 gets you to 6088. And we can bring that right up to here, 6088. So adding them together gets me to equity of 6238. Okay? So total equity, I'll bring that down here to 6038. So non-current liabilities, well, let's look in here. Do we have any long-term loans? We have 5720. So a lot of this is either taken from the workings or taken from the trial balance. Do we have any other long-term liabilities? If we look down here, long-term liabilities, deferred income of 52,000 should I say. So deferred revenue of 52. Now get that reference to the working as well. So that is working 3. And also our pension liability, which is a liability of 145. So SOFP, I should have put in there NCL to show the figure 145 of working 4. So this is working 3 and working 4. Pension of 145. And adding them up gets me total long-term liabilities of 5917. Finally then, current liabilities, we have our overdraft in, trade payables of 1675. So I'm just move this over here to be consistent. And that's from the trial balance as well. We have a tax for the year, we know from working 4 or 5, working 6. Our tax liability for the year, current liability, that's why it's good to label, is 185. 185. Working 6. And we do have other ones. We know we've deferred income, or deferred revenue, whichever one we want to call it, from working 3. And that gets you to 35, 34 in this instance. 34. And do we have any other one? We look down, checking the balance sheet, everything else is done. Current portion of loans, we watch that at 540. So current portion loans from the TB gets you to 540. So add them up, gets you to 2569. So we add the 3, all our equity liabilities, gets you to 14724, which thankfully, and we'd love to see this for the exam, they both balance up. But again, it's not the end of the world if it doesn't balance up. The point being is if you had a logical approach all the way down along, that you would have been gradually gaining marks. And that is a lot of the feedback the examiner is giving is students are not following a logical approach, they're being very ad hoc, and as a consequence they're losing a lot of marks. So the point being is if you take a 3-step approach, understand the information that's given and what's required, then systematically work down through each of the workings, and then populate your financial statements, you will make a lot better attempt at your question 1 in summer 2015 exam. And remember, it is, as of last year's paper, if we look at how much the marks were worth, it was worth 50% of your paper, so it should be given 50% of your time. So that is a ballpark 100 minutes, nearly all in. So again, marks per minute is an important allocation. What are the marks going? How much time should I allocate towards it? So hopefully you found that useful. That was last year's Summer 14 question 1.